Wealthy and Wise is your guide to value investing, powered by Teaminvest.
Good afternoon and welcome to Wealthy and Wise. Well, today it is a stock-specific extravaganza. We asked what stocks you'd like Teaminvest to rate using its conscious investor platform. Think of this like a mini The Call, only value investing style. So we'll get you to your requests in just a moment. Let's quickly, though, add some value. Andrew Coleman from Teaminvest and Sanjee Narendran from Teaminvest are here to answer your stock-specific questions. But guys, before we get there, I just wanted to start with the basics. How do you approach stock picking through a value investing lens? So this is putting everything that we've learned in the past episodes into practical use.
Yeah, look, exactly that, right? We just follow the same process for each company. So I think we'll be doing that today. And that's really start firstly with asking, what does the company do? And does that generate a high degree of return on equity with little or no debt? Because that's the first question. Is there a moat? Is there value that this company is able to extract from its customers because it adds value? That's the first question. The second then is it growing with a high degree of stability? As we spoke about only a couple of weeks ago, stability is the core for being able to make any form of good long-term prediction in terms of value. And then thirdly, ask where does it sit relative to the market expectations? Remember that price and earnings chart that differentiates, and we'll use that today by looking at the PE ratio. We then do two extra things in Teaminvest, which we're not going to cover today. The first, of course, is that we then get the views of the wisdom of our crowd, our 700 plus members around the country in our 9 plus meetings a month to discuss that. Obviously, we can't possibly do that here today.
Nope,
we don't have 700 people, so we won't do that piece. And then the last piece is we use our software with those assumptions that we've now fed back through the group to determine a reasonable buy price. Or another way of putting it, what is the return I can expect today if those assumptions hold? Now, for today's episode, we're just going to use the default that's spat out by the software as opposed to the wisdom of the crowd, because we can't. But that should give you a pretty quick overview of how any value investor approaches or should approach the question, and hopefully be educational and exciting.
It's always exciting. What are you saying, Andrew? And Sanjee, you guys still, though, and I take all of that on point, but you're still considering management, you're still considering incentives and the like.
Absolutely. And we probably won't cover that as much here. That's something that our members do in their meetings. But right now we'll look at, what can you do on the cursory level, the first level, to identify is this a good company or not.
Great then. Let's go head to head for a buy, hold, sell recommendation on 10 stocks picked by you. Well, coming up, and it's a bit ambitious, but we're going to attempt to get through in detail Jumbo Interactive, XRF Scientific, Ampol, Washington H. Soul Patts, and Harvey Norman. Now, if we have time, we will also get through, and I think we will, Cochlear, Ansell, Car Group, Codan, and Qube Holdings. So let's get right to it. Gentlemen, Andrew Coleman, Teaminvest, Sanjee Narendran, as always, good to have you here. Jumbo Interactive, this one is to start, and this one is for our regular viewer, Robin.
Yeah, great company to start with, because obviously Jumbo is one that we've talked about a little bit on the program. So look, Jumbo, if Sanjee, you just want to pull up Conscious Investor, it's ticking all the boxes at the moment, but let's work through them as if we were a value investor. So the first question is to ask, what does Jumbo Interactive do? And I assume for Robin, she knows this, but for the other viewers at home, it operates lottery software. So that's lottery software for Australian lotteries as well as in the United Kingdom, and operates 2 lotteries itself now that it's acquired through acquisition in Dream Car Giveaways, UK and United States. As a result, it really does have some pretty strong moats. I mean, that's a competitive advantage, and you see that in a very high return on equity at the moment of 33%. And Sanjay, if you just want to bring up the charts, you can see that return on equity and return on capital of such a high figure has been driven for the last sort of 10 years. Now, as a value investor, you want that to be at least 10%. Anything above that's lovely, but it's cream. Why 10%? Well, that tells you 2 things. Number one, there's a moat, because anytime you can get reasonable margins, it says you have a competitive advantage. And secondly, at the end of the day, return on equity acts as a cap on how fast the company can grow with each new dollar invested. So this is wonderful from return on equity and return on capital. The next question we would ask is the growth of the business. Are they able, and management and the business able, to turn that high return on equity and competitive advantage into growing profits, which is what we as shareholders receive? And as you can see, that looks pretty lovely. We talked about stability a couple of weeks ago. That's actually a stability of 95% in sales and 95% as well in earnings. So a really wonderful chart showing that this business has taken earnings from, what's that, about 10 cents per share back in 2016 to close to 60 odd cents per share today. So wonderful growth, all of the signs we want. You always want to check that that hasn't been driven by debt-fueled acquisitions, which it hasn't in this case. Debt to equity is only 12%. And so knowing that, we can ask the final question, subject to the wisdom of the crowd, that idea of are there moats and risks that we're comfortable with, and remuneration, as you mentioned, but we don't have that time today, which is, given that this is a business I now would like to own and is stable and predictable, what price should I pay? So Sanj, I'll take that over for you.
So if we're looking at Jumbo now, we see that currently it's trading at around $7.64. I mean, if we forecast it out, we're expecting a growth of maybe, say, 21%. If you look at everything down our default figures there, you'll be able to see the growth at about 21%. It's roughly paying out about 83% of its profits. So we can expect over the long run that we should have about 41% return, thereabouts, if the business continues to do exactly what it has been doing and continues to do that over the next 5 years.
So is this a buy, hold, or sell for Robin today?
Yeah, well, look, at a PE of 12, which you can see at the bottom of that fear and greed chart, and offering you, assuming history continues, a 42% per annum return from here, assuming the market returns back to a normal PE for this company and it keeps growing the way it is, I'm not sure of too many places that you could put your money and get a more wonderful return than that. Now, the piece we've missed today, of course, is that wisdom of the crowd that we and our members would be doing in a lot of detail, our 700 plus members around the country, which is sense checking those assumptions. Is there a moat problem, a risk problem, a management problem that means that shouldn't be our starting position? But given today we don't have that time, I think if you could find a business that ticked all of our boxes before around return on equity, growth, management, moats and risks, that's offering you a 40% plus return, that sounds like a buy, doesn't it?
Yeah, okay, so that's a buy, Robin, for your first company that you were asking about, Jumbo Interactive. Now, Robin has also, and because she's a regular viewer, I let her ask 2 questions. It's XRF Scientific, XRF. So, Andrew Coleman, very different business.
Yeah, look, in X-ray fluorescence spectrometry originally, so looking at the composition of minerals, they've just bought a gas composition analysis business, which makes things probably a little bit more interesting from an analysis point of view. But again, from a value investor, starting at the same point, let's ask that question: how's return on equity and return on capital performed? 10% being our sort of cutoff, so at least from 2021, this company has done very well. First few years, maybe as it was smaller, struggled a little, but recently up around 15%, looks really good. We want to ask the question, has that been achieved with lots of debt? In other words, have they fueled that by taking on leverage? And of course, the answer there is no. They've got very low debt to equity. That's about 5%, if you can see that on the chart. And then we want to say, has that translated into steady growing profits? In this case, we can see sales and earnings growing very steadily in a very nice staircase pattern. And in fact, in this case, a 92 and 94% stability. So not quite Jumbo's 95, but still well above most things that we cover in the call, which tells us that this is a business that you can make predictions about and that must have strong moats. So assuming that you don't have any time to cover it in more detail and look at management, look at its moats and look at its risks, you would then again jump to the calculate return page. And over to you, Sanj.
Well, if we're looking at XRF, the price is just short of $2. Now, we're expecting an average PE somewhere around that 2021 mark in the future PE, and it's been having about a 31% growth. So if we assume all of those continue going on, and we don't have any reason to assume otherwise, then you could expect your portfolio with Jumbo in it to grow around 30% or just short of 30% over the next 5 years.
Yeah, and that's just for the record, that's per annum. So the calculations we're showing you here are the annual expected return from holding it, assuming over the next 5 years things continue the way they were. Now, the only red flag potentially you can see at the bottom, that fear and greed bar, says that the PE at 26 is at the higher end of XRF's trading range and is above the long-term market average. But then a company growing at 30% per annum probably, or could be argued may justify a little bit more than the market average. I think at 26, I wouldn't be concerned. If that number was, 46, I would definitely be worried. But at 26, I think you can absorb that. And it looks like, well, certainly, if the history continues, a good buy.
So that is a buy for XRF Scientific. And I think it's probably appropriate for me to just do the usual shout out that this is information only. This is not personal financial advice. So let's get to the next on the list. And this one's for Tim. Tim, thanks for writing in. Wanted to know about Ampol. I'm sure it's because we had an update coming from the company. And I'm sure it also has something to do with the fact that we've got a gas shortage here still with the Strait of Hormuz closed. So what do you make of Ampol?
I'm not sure if I was on the call with you or Andrew the other day and Ampol came up, and I was not particularly positive about it as a business or as an investment. I mean, it's just different to whether it does a good thing for this country. And I think you can see why if we flick to Conscious Investor. Just go to the summary page for a second, Sanj. Our little traffic light system we've been looking at. Look how many reds and oranges the software is flagging. That's even before we look at it as a business with our members. It's got very low stability of earnings, 33%. Stability of sales, just making the cut at 80, but certainly not the kind of stability we've looked at for the last two companies. Return on equity of as low as 4%, return on capital of 1.9, debt of over 100% of its equity, meaning it's highly leveraged, and potentially even with some liquidity concerns given its interest coverage ratio, which is that IC, is down at sub 1. And it's trading on a PE, you can see that little bar again, of 64 times earnings. Mm-hmm. None of that is exciting for a value investor. And if you want to see it visually, Sanj, maybe just bring up that growth chart, because we talked about stability a little while, about 2 weeks ago. Not the earnings per first price, just the growth. Thank you. Where's the stability in that? And where's the growth in that? So as a value investor trying to make a prediction into the future, what number would you put into that calculate return, that model? And I think from that point of view, we would say far too hard, walk away. Interestingly, if you do run the default scenario across it, you don't get a very pretty picture because of the high current PE, but at the same time, it's garbage in, garbage out, right? You're trying to make a prediction about something that you have no idea where it's going to be.
Wow. Okay, so I think we can skip to the next one because that is most definitely an avoid or a sell for Ampol. And this is where it gets a little bit more interesting because you mentioned Warren Buffett quite a lot, and I have been told by many investors over the years that Washington H. Soul Patts is the closest thing Australia has to a Berkshire Hathaway. So, Washington H. Soul Patts, this one is for Jen. Andrew?
Yeah, I think there's two Australian companies that model themselves after Berkshire Hathaway. The one is Soul Patts and the other one is Tip. But given the difference in market cap, we can absolutely focus ourselves on Soul Patts. What I would preface is saying that the challenge when you look at any conglomerate under the current accounting standards is that your stability is going to go all over the shop and effectively be very low, because the mark-to-market accounting standards mean that you're going to have big one-off gains and big one-off losses all the time in the statutory numbers. And you see that in the most recent half-year result from Soul Patts, if we can bring that up, where they reported a half-yearly statutory profit of $2.3 billion, while at the same time telling all share market investors that their actual earnings, excluding these mark-to-market accounting tricks, was really $304 million. So the first thing you want to be doing if you're holding a business like Soul Patts or Berkshire or Tip is be prepared to actually look at the underlying results. Don't just take the P&L and balance sheet at face value. Now, for most people, that probably puts it in the too hard basket. You've got to do a lot of extra work. But if you're like our members or, at home and you want to put that work in, then the simple way to do it is just simply look at it on a PE basis or a net asset value basis and ask yourself the question, given the current net assets of Berkshire Hathaway, Soul Patts, Tip, and the current share price, does it look like a buy? Go back to that Benjamin Graham sort of simple approach that we talked about in the very first episode. And in the case of Soul Patts, they've got a net asset value per share of $36.40, growing at 11% per annum, and they've got a current market price of about $42. So you'd say that's on the little of the high side, but not stupidly high. And if you looked at it on an earnings basis, that $304 million of underlying earnings, or regular NPAT as they called it, translates to a PE of about 25. That's 304 for the half, so 600 odd for the full year. As a result, I think that's a hold. It is neither fearful nor greedy. A PE at 25 times, growing at 11% per annum earnings. That's good. It's not outstanding. It's not a wonderful value investment buy, but it's also not a sell. But I think to come back to the key point, because the accounting standards mess around with the numbers, Soul Patts, Berkshire and Tip are businesses you want to follow properly, not just read a broker report, or you'll get caught up in all the one-off stuff.
Okay, that was pretty thorough for Washington H. Soul Patts. So let's get to the next company on the list, and that is Harvey Norman, HVN. So a bit of a vexed sector right now, being retail in a rising interest rate environment, but this is a company that has your 10 years plus of history to look at.
Many more than 10.
Yeah, of course. It's diversified in the fact it's overseas, it's got a franchise model as well as store-owned model, it has property, and the share price has performed quite well. So what do you make of it?
Yeah, look, I mean, like all retailers, Harvey Norman suffers external headwinds. As a result, sometimes the stability isn't as good as you would like. But Sanjay, if you want to bring it up, we can run through that example. So here we go. Let's have a look at return on equity and return on capital. Is there a moat that Harvey Norman has? Well, return on equity and return on capital are around at the very top end, that 10%. It's actually a little bit under. It's in the high 9s, but it's 9.6. So, that's not bad. It's just maybe at the bottom end of what you'd consider acceptable and understandable in a tough, business line. Its earnings growth, Sanjay, if you just want to bring it up, earnings have been growing, sort of. I mean, sales have sort of got a nice-ish steady path upwards. It's actually got quite high stability of sales, but earnings have been sort of, up, down and sideways, as you would expect in the environment of retail. A little bit higher than where they started 10 years ago. So, if you want to run the numbers on that, you'd say that earnings have been growing at a rate of about 4% per annum with 75% stability. So that's not particularly exciting, but it's not a problem from a forecasting point of view. And assuming you can get comfortable with how Jerry Harvey and his wife and their management team remunerate themselves, which is another question that our members would always have, it is one that's worth going to the calculate return page and trying to ask the question, is this a business that's worth owning? And again, we mentioned debt before, but debt is sub 50%, which is pretty good for a retailer.
All right. Sanjay, anything to add there?
Not really. I mean, if you are interested in investing in it, current price is sitting around that $4.50. The forecasted PE is not very high. It's only sitting around 10. It tends to have a short range of where it trades between a 12 and 14 PE in most cases. And you'd probably get about 9.5% out of this over the next 5 years if you were invested in it. So it's not particularly bad, but this is where you might want to go and have a look a little bit deeper and understand some of these businesses with the moats and risks and the other things that we'd also consider.
And so, buy, hold, or sell?
Yeah, I think if I was speaking for our members, it's a sell because there's better things out there and you've seen two better of them. But I think if you're a viewer who already owns Harvey Norman, 9.6% per annum is a reasonable return. It's not on a particularly high PE at 11.2 at the moment. I wouldn't be rushing to exit. It would be a hold. But I think, to Sanjee's point and to your question, if we're doing a pure value investor analysis on it, it's probably not quite good enough.
Okay, so now here it gets interesting because last week, of course, that we had this major downgrade coming from Cochlear. On the day, share price was down by 41%. I don't think you need me to go through the whole story. It's a sad story, though. But my question, and I'm sure that's why Rowan has written in about it, is this now looking good value?
Yeah, well, the classic thing is Cochlear as a business is a very good business. Maybe this has triggered a risk, and we can talk about that if we had more time. But it was trading on stupidly high PEs, and we've spoken about that before, you and I. For the last 10 years, it's regularly been in a PE in the high 40s or early 50s. And you don't have to get a lot wrong to change sentiment down from a PE of 50 to a PE of 18. I mean, it's dropped so far, it now looks cheap compared to the long-term market average, but only just. A PE of 17.6. We just saw Harvey Norman on 11. We've seen Jumbo on 12. So it's not exactly super cheap.
Yeah, but I see a lot of green ticks there on my screen.
Absolutely, which is the difference between the business and the price. And we've talked about that a lot, the difference between business and price. Here's a company that over the last 10 years, if Sanjay you want to bring it up, has continued to grow earnings, not super fast. If we look at the growth rate here, jump to growth rate, Sanjay, if you can. If you look at the growth rate here, over the last 10 years, it's been growing at about 3-4%, actually 5.6%, with a high degree of stability. So I think the challenge for us always on the call, when we talked about Cochlear, is to a Teaminvest members' point of view, if you actually looked at the 10 years of data, This is a wonderfully growing business with stability, but it's a slow growing business. It is not the 15, 20, 30% plus that brokers kept putting in their forecasts. And the only reason I think they could possibly have done that, other than getting carried away in the story, is I think they kept making the mistake of valuing its earnings growth from 2020, which was depressed, to now, rather than looking at it over a longer cycle. You know, Cochlear is a mature business. It's not going to grow at double-digit rates. There's not double-digit numbers of new people needing hearing intervention, right? So from that point of view, it has got, you know, strong moats. You can see that a return on equity and return on capital of around 20%. Very stable and growing business, but stable and growing at 5%, which to a value investor, and you can pull up the calculate return point of view, Sanjee, justifies a market average PE, which it's now on. But it wasn't on that for a while. You know, when we did our earnings and price chart of the deviation, you can see just how far that deviation was.
So Sanjee, would this now be a buy? All that being said, tell us what we're looking at.
Yeah, so even with the price coming down to around those, mid-90s, it looks pretty decent. As Andrew said, it's a very slow growth company, but it's a stable, reliable growth company when you would take it out for the longer period. You'd want to see that there's been a sudden drop in price. What's triggered it? You want to pay attention to understanding, has a risk triggered, has a moat been breached, those kind of things. But if you look at the business, it looks like a very stable business that has been performing, and you can comfortably expect a decent return out of this over the long run if you get it at the right PE.
Now, one thing I will just bring the viewers' attention to, have a look in that assumed PE ratio, that sort of third line down. Under the default, it's saying 45, that's the history of the last 10 years, the average, versus under safety, it's telling you 15. Now, the reason our software is doing that, by the way, is it's saying PEs of 45 are not sustainable. The odds are that the future is not going to look like the last 10 years. And so depending on what you assume the long-term PE will be, you might end up with a very different view, not on is Cochlear a good company, but what is the right buy price for Cochlear? Now, I mentioned we wouldn't get into the proprietary stuff, which is the 700 plus members discussion about Cochlear, but I don't think there's been a meeting in the last couple of years as Cochlear has been riding high where we haven't had that exact discussion in the membership. What is the appropriate long-term PE for Cochlear, was CSL, TNE, Pro Medicus, etc.? All those companies that are great companies but have been on really inflated PEs. And, you know, we've talked about it on the call, but PEs of 45, 50, 100, they don't stay that way forever. Eventually sentiment turns. I think 17.6 is now starting to look, you know, fair or maybe even slightly cheap. But, you know, as you've seen with Jumbo, Harvey Norman, it can get down to low teens. CSL's on about 13 at the moment. So I'd be starting to get interested now as a Teaminvest member, and I know our membership are, but you really want to, as a viewer at home, be comfortable. What do you think the long-term PE will be? Because that's a key element in your calculation.
So that is, I think on the call, we call it a nibble for Cochlear.
Yeah, look, I'd say it's a buy at 95.
Okay,
it's just not a back the truck up buy yet. See if you can get it a little cheaper later.
Got it. Okay, let's get to the next on the list, and this is Ansell for Pat. So if we're talking about sort of slower growth, not shooting the lights out company, I would say Ansell's kind of a poster child for that, is it?
Yeah, absolutely. I was going to make a prophylactic joke, but I won't. Look, I think Ansell is an interesting one when you look at it through our methodology, right? Because we've talked about there's a few key things. Firstly, is return on equity and return on capital above 10%? And the answer is no, it's not in Ansell. It's high single digits, sort of 8, 7, 6, but it's not above 10%. That's going to limit your ability to get a return. The second thing is we want businesses that are growing stably, which Ansell is. It's got a high degree of stability. The problem is Ansell's growth is less than inflation. So in other words, the value of your money is stable but eroding over time. You can see that Ansell makes roughly the same today as it did 10 years ago, despite all the inflation in purchasing power. And its debt to equity is reasonable at 41%. So the only way you're going to make good money out of Ansell as a value investor is therefore paying a very low price, because you're not going to get any return from growth. You're not going to get a lot of return from, the underlying return on equity enabling them to deploy more money to increase growth and earnings. The only way you're going to do it is by PE or multiple arbitrage, which would immediately mean, for me, there are better places to put your money. But if we have a look at it on a calculate return page, you can ask the question, what is the right price you should pay if you would like that business? And Sanj, that one's for you.
Well, if you want to work out what the right price to pay, it kind of depends on the type of return you'd be expecting. But if we know they've got about a 2% growth rate, they're only got about a 6 or 8% return on equity, let's say the returns are about the same that you want there, we would then just go in here, say, let's call it 8% return out of it, and your buy price would be around that $20, $20.80. So still a bit on the high side, but if you'd like to get around 8% return out of Ansell, then you'd want it a bit cheaper than where it is at the moment.
Yeah, so what Sanjee's done there, just for everyone watching at home, is we've copied across the default and just amended the required return, because this is a dynamic model, of course, to say instead of wanting 10% for Ansell, you're comfortable with it just achieving its return on equity. It's not going to get much faster than that. You've decided that's okay. So if it gets 8%, you could pay a maximum of just under $21 a share. So what would we call that? At a price of 27 now, 30% lower, would we call that a sell? Probably a sell.
I think that would be a sell. All right, let's get to another company. Some call it a growth company. It's a tech company, one of the OG tech companies listed here in Australia, and that is Car Group. So Car Group for Lisa. Lisa, thank you for writing in. Again, I don't know if Lisa already owns it or is considering buying it, but this is a company that has come down in share price quite a bit. So does the price now justify the business?
Yeah, well, it's come down a lot, but it's still on a PE of 33 times.
Okay,
so we spoke about, how far they can drop if they were
but
on a high
here's a
number.
question. If you're looking for a higher growth company, particularly in the tech space, do you also have to just prepare yourself to perhaps pay a higher PE for it?
If I was being compensated by selling you stocks, absolutely. If I'm being compensated by making money out of where I invested, don't fall for that BS. Really simply, the market's got a long-term average of about 20 times, between 18 and 20 times, and a standard deviation of about 2, which means once you get mathematically beyond a PE of 30, it's about a 1 in 1,000 year event that it will stay above a PE of 30 for long. Now, we've been going through a pretty big cheap money era, so a lot of companies' PEs have been lifted. But a hell of a lot of what we're just seeing in the market right now, which looks like big losses for growth companies, etc., is just a reasserting of reality. We've made that joke about Icarus flying too close to the sun before. If your PE is high, the ability to sustain that for, say, 5 or 6 years is a 1 in 1,000 year event. Given there's 2,000 companies on the ASX, that's 2 in every 1,000 years that we expect will do that. That's not odds I'd like to play, but if I'm a broker selling you the stock, why not? I get paid whether you go up or down. Maybe I get to sell it to you and then as a buy, and then convince you it's a sell when it drops and get my commission twice. Or perhaps I'm being too cynical. If we look at Car, though, from a business, not a PE point of view, return on equity and return on capital around 10%, just under at the moment, but used to be a lot higher. That's the result of acquisition. So that's not a great sign, but it's not appalling. That's not an immediate throw it out baby with the bathwater, but it's not super amazing. Earnings growing over the last 10 years at about 7% per annum with 72% stability, sales growing about the same. You see that in that chart. So look, that's now looking better. This is a fast growth business. Can it sustain that with return on equity sub 10%? Well, maybe that'll be hard. A reasonable level of debt at 47%, mostly through acquisitions offshore. So it's a bit leveraged, but not stupidly leveraged. And as a result, about 2 to 3 times the size in earnings that it was 10 years ago. So it is one we actually hold in our portfolio, and we know our members hold in Teaminvest. You can see that under Intel, there's 22 times we've talked about it. But it is one that's controversial, because trying to calculate from here what is the likely growth of Car going forward, given you have a divergence between return on equity and historical earnings growth, is always a debate for our 700 plus members, which is probably a lovely segue to throw to you, Sanj, to talk maybe about what it looks like under default, but then also under safety, to show the impact of that debate.
Yeah, because I think over here, this is where you'll see a bit of a difference. So with the current price, if we were to buy it now, you're looking at about $25 for it. Now, out of that $25, over the next 5 years, you'd expect a return of somewhere between 3.5 and maybe 13.5. So 3.5 is here. This is our margin of safety. This is after I've gone in and our membership have gone in, and we've understood that there's certain levers we have to tighten up to give ourselves a buffer there. But otherwise, under a default, you could go as high as about 14% or 13.5% return, if you assume that everything that has happened over the last 10 years continues to do so.
And you'll see the two big reasons that that's come down is the PE ratio, under default, just taking the last 10 years of data, is saying the average has been 39 times.
Yeah.
And our members and software are saying that is unlikely to continue, like we spoke about, and put in 25. And then similarly, the growth rate was around 7% for the last 10 years. Under margin of safety, we're bringing that back because the return on equity isn't high enough to keep justifying the same growth rate without something breaking.
So you've got quite the dispersion there between margin of safety and the default. Would it be a buy, hold, or sell?
Well, it depends on what the return you're looking out for. And I think we keep talking about buy, hold, and sell, but what I want to look at is understanding the business a little bit more and understanding some of the nuances behind it, because otherwise we turn into the call.
Yeah, and I think to Sanjee's point, you know, it's a question of do you hold it already and why, and what is your assumed growth rate and PE going forward?
Okay, so Teaminvest members hold it. Would you be buying around today's price again?
No.
Thank you. That's the answer. This is the mini call. All right, let's get to the next on the list. And that is, let me see what we've got coming up for whom. It is Coden. This one's for Charles. Again, you know, hot area of the market, has been on quite a run, but has pulled back in price. I get why people are sending this into the value investor program.
Yeah, look, and I think we've said on TV as well, we're in the top 10 shareholders of Coden,
Yeah.
have been for a long time. But we, across our membership, have been slowly selling down at these prices.
So taking profits.
Absolutely. So I think from that point of view, I'm going to have to say it's a sell because that's, we're voting with our feet. The question is why, going back to it, it's not the business. This is a wonderful business. You can pull it up and see that high return on equity around 20% per annum, or here on the simple page, everything in green, good stability, good return on equity, good return on capital, low debt, high, management's trustworthiness. We know the management very well. But at the moment, it's on a PE of 50.8. And so as soon as you run that through to the calculate return page, the level of assumptions, I mean, look at that lovely earnings chart, right? It's beautiful. But from the level of assumptions you have to make to keep justifying this share price, they start to border on the realms of silliness. You've got to assume the PE is going to be high forever. You've got to assume growth rates in the high double digits forever. And mathematically, that just becomes riskier and riskier. So from that point of view, a wonderful company, ticks all the right boxes, but it's not a wonderful company at a reasonable price right now, as you can see right at the very top of the Fear and Greed Index for this company.
Okay, so that is you sticking to your knitting. I think this is really good because it doesn't matter if you like the company, it doesn't matter if you like the management, you have to just take the emotion out of it and you are figuring out what you're willing to pay for the company based on what.
Yeah, one slight caveat. It does matter if you like the company and management because you shouldn't own it if you don't like the company and management. But just liking the company and management is not a recipe for a good investment decision.
Okay. Now we've got just a few minutes left. Can we do for Mick, because he took the time to write in, Qube Holdings, QUB. Well, logistics has become very important, hasn't it?
Yeah, it is. And Qube's actually one of our big customers in one of our private equity assets. So I've got to be a little careful what we say. But if you pull it up, like so many heavy infrastructure type owners, I mean, Qube runs big transport fleets. It's very hard to retain or maintain a high return on equity and return on capital because it's a highly competitive space. What is your moat really in logistics? Who's got the fleet available to win the job at the current time? So as a result, like retail in many ways, it's very hard to develop strong long-term moats. And you see that coming through Qube's numbers. Earnings have been growing with a high degree of stability, you can see that. But the return on equity and return on capital are low single digits, debt to equity of over 100%. They've had to take out a lot of debt to buy that fleet, to win that work. And as a result, as a value investor, I think you just say, look, there's too many red flags here. And then, of course, at a PE of 29, you might also say, and the price is too high. So I don't think we need to go to the calculate return on this page, other than to say it's a really good example, Qube, of here's a business that is growing quite fast. It's growing over the last 10 years at an average 10% per annum, but it's doing so with very slim margins and high debt to make that work. And as a result, for us as Teaminvest value investor style, investors, that's a risk you don't need to take.
Okay, so that is the last on the list. Look, this was a bit of fun. Nice to get some insight into the Conscious Investor platform yet again. Look, we're going to skip the viewer question for today because those were all essentially viewer questions. However, you can email us at wealthy@ausbiz.com.au if you have a question specifically for this program, or if you've got an idea. I mean, maybe we should do this another time. Maybe we do this once a month. We'll see. Look, guys, thank you, Sanjee. Andrew, as always, thank you for watching. And we look forward to seeing you next week for Wealthy and Wise.
Wealthy and Wise is your guide to value investing, powered by Teaminvest.